All right, let's dive right in. There's a massive question shaking up the financial world, and it's pitting one of history's oldest assets against one of its most powerful institutions. We're talking about gold, the Federal Reserve, and a potential price target that has investors absolutely buzzing: $4,000. And this is the question on pretty much every investor's mind. You see headlines like this everywhere, and they perfectly capture the drama, right? They tie the fate of gold directly to the decisions of the U.S. central bank. But is the relationship really that simple? Let's break down the mechanics. To really get a grip on gold's future, you first have to understand the two main players in this whole story: the precious metal itself, and, of course, the U.S. Federal Reserve. Their intricate dance is really at the heart of everything we're about to talk about. So, who is the Fed? Well, think of them as the managers of the U.S. economy. Their primary and by far most powerful tool is the ability to set the benchmark interest rate. When they decide to raise or lower this rate, it creates these massive ripples that affect everything, from your savings account all the way to the global markets. And this brings us right to the core of that $4,000 question. What happens if the Fed looks at the economy and says, you know what, we need a boost, and starts cutting interest rates? This is the path that has so many people speculating about a brand new gold rush. But what about the exact opposite scenario? What if the Fed holds firm, keeping rates steady, or maybe even raising them? Well, that creates a completely different set of incentives for investors, and it leads to very, very different results for gold. Okay, let's explore that first scenario, the cut. We're going to break down the chain reaction that gets set in motion the moment the Federal Reserve decides to lower interest rates. You see, an interest rate cut is so much more than just a change in numbers on a screen. It's a really powerful signal to the entire financial system. And this single action is what could kickstart a major rally for gold. So this one move sets off a pretty simple three-step chain reaction. First, the Fed cuts rates. That tends to make the US dollar a little less attractive, which can cause it to weaken. And since gold is priced in dollars all over the world, a weaker dollar directly pushes the price of gold higher. It just becomes a much more attractive safe haven asset. Now, at the very heart of this entire dynamic is a really crucial economic concept: opportunity cost. It's kind of the hidden force driving an investor's decision when they're choosing between an asset like gold and a traditional investment like a government bond. Think about it like this. Gold's biggest weakness, its biggest drawback, is that it doesn't pay you anything to hold it. No interest, no dividends, nothing. But when the Fed cuts interest rates, government bonds and savings accounts also start paying very, very little. So suddenly, the opportunity cost of holding gold goes way, way down. You're just not missing out on much by choosing gold over a bond that's barely paying you anything. All right, now let's completely flip the script and look at scenario 2, the hold. What happens if the Fed keeps rates high, maybe to fight inflation or just to signal that the economy is strong? In this scenario, the Federal Reserve basically sends a signal that the economy is doing just fine or that inflation is still a worry, so it keeps interest rates high. And this completely flips all the incentives we just talked about on their head. Here, that chain reaction we saw before works in reverse. Higher rates can actually strengthen the US dollar, which creates a headwind for gold prices. But more importantly, government bonds and savings accounts suddenly start offering much more attractive guaranteed returns. And this is where that whole opportunity cost argument just does a complete 180. I mean, ask yourself, why hold a zero-yield asset like gold when you can get a solid, safe return from a bond? Suddenly, the opportunity cost of parking your money in gold becomes really high, making it a far less appealing choice for most investors. So this leaves us with two completely competing paths for the Federal Reserve, and by extension, for the price of gold. One path could lead to a massive surge, while the other would probably keep its price pretty grounded. The future of this precious metal is just fundamentally tied to these major economic decisions. It's a constant tug-of-war between the appeal of gold as a store of value and the real returns offered by other assets. And it's all dictated by whatever the Fed decides to do next. Which, of course, brings us all the way back to that central, multi-trillion-dollar question. Will all the new economic data push the Fed toward a cut, potentially unleashing that new gold rush? Or will a focus on stability keep rates high, favoring other assets instead? The world is watching. The only question left is, which path will they take?